Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra, where we are in the middle of the earnings season, which is in full swing. In fact, over the last 2 or 3 days, we have actually seen some of the biggest heavyweight come out with their earnings, starting with the big boy Reliance Industries, banking majors, ICICI Bank, Kotak Mahindra Bank, the IT bellwether Infosys, and even the cement major Ultratech Cement. All of these stocks have been in focus right after their earnings. So let's discuss each of them to understand what should really investors be doing and how do they analyze these numbers, and going forward, what should be the right investing strategy for you. To help us with all of this and much more, I'm joined by a very special guest. Mr. Siddharth Khemka joins in. He's the head of retail research at Motilal Oswal Financial Services. Thank you so much, Siddharth, for taking the time out for this discussion, and welcome to Business Today TV.
Yeah, thank you, Sakshi. And warm welcome to everyone else.
Thank you so much. So, Siddharth, let's start with the big boy Reliance Industries. Now, very strong numbers coming in there for Reliance Industries, Q on Q, year on year basis. The oil to chemicals business has reported highest ever quarterly revenue, the best revenue for Reliance Retail as well. Reliance Jio has done a strong show, 26% on a year on year growth. ARPU has gone up sequentially. Subscriber additions have come into both EBITDA and margins on a consolidated basis have gone up. The profits have gone up, and yet, despite all of this, the stock cracked almost 3.5% in trade. So, help us understand, what do you make of the numbers and what really disappointed the street?
Yeah, Sakshi. So if you look at Reliance, it's a behemoth with separate business segments, and you have to look at each segment separately. And the biggest expectation from the street, from Reliance Industries this quarter, was from the standalone, or you can say the core oil to gas business, and which is where the disappointment came in, especially in terms of the margins. If you look at the other two key business segments, that is Reliance Jio, they reported strong numbers. ARPU improved 5% on a sequential basis. There was strong recovery in the subscriber growth after 3 quarters, which drove the EBITDA and revenue. And if you look at the retail business, I think that also benefited from the opening up of the economy compared to last year, when the third wave of COVID impacted the stores and the retail outlets. So I think again, the Reliance Retail, there was a strong growth in revenue, up 54%. EBITDA was up 98%, and footfalls recovered to almost 19% compared to the pre-COVID level. So both these segments reported strong numbers. However, the core oil to gas, oil to chemicals business, there the EBITDA was 14% lower than our expectation, although it did grew 92% on a Y-on-Y basis. But if you look at the key matrices that we track, that is the EBITDA per metric ton, it came in at about $170 per ton, compared to the expectation, the street expectation of about $180. And that is where the EBITDA margins were slightly missed, and that led to some disappointment, especially because the stock had seen some ramp up or the up move in anticipation of a strong quarter.
Okay, well understood that. But what would you really advise all the investors to do post the Q1 numbers? We're also heading towards the AGM now, and before that, we've seen some big developments on the change of guard now, and Mukesh Ambani passing on the baton to the next generation for all these new age businesses of the company as well. So help us understand, how should long-term investors who've been holding Reliance Industries as a part of their core portfolio, looking to accumulate now ahead of these new developments and changes, what should they be doing?
So our view on Reliance is very positive. I see the core business would have their cycles, but if you look at the new age businesses, they have now stabilized well. Now Reliance is embarking on a new business, that is of alternate fuels and renewable energy, which is leading to increasing debt in the near term, but that is how they have built the other two businesses, and that will kind of remove the volatility, or you can this the cyclicity from the core business dependency.
Yeah.
So there could be announcements in the AGM, and there is clearly clear succession planning that is underway, given that in between there were concerns on the health of Mukesh Ambani. So I think that's a positive step, and more clarity can come in the AGM. So overall, I think we are clearly very positive on Reliance from a long-term investment perspective, and corrections like these offer a good opportunity to accumulate the stock.
Okay, understood that. What about the IT earnings? Now, we've seen so far disappointing earnings coming in from the IT top majors, even the mid caps, for example. Now, Infosys, India's second largest IT services firm, reported a lower than estimated about 3% rise in the June quarter net profit amid the escalating costs. The net profit of 5,400 crore rupees, or about 12 rupees a share, compared with the 5,000 about 200 odd crore rupees, or 12 rupees, 12 and a half rupees per share in the same period. How are you looking at these, metrics of the and the fine print of the Infosys earnings? And what do you really suggest? Because the stock has really not reacted positively again.
Yeah. So you have already laid down the details of the earnings, but if you look at what is happening is that within the IT space, the top line growth has been pretty strong, while the disappointment again has been mainly on the margins front. While the street was expecting some pressure, increase in cost for IT companies, but the actual increase, the reported increase, has been much sharper, and that is leading to a compression in margins, which is kind of suppressing the earnings. If you look at the Q1 Infosys numbers, the dollar constant currency growth was 5.5% on a sequential basis, compared to a 4% of what we were expecting. And if you see the performance, at least on the revenue front, was driven by strong growth across segments, be it manufacturing, communication, retail. But the EBIT margins of 20.1% was down 150 basis points Q-on-Q, and was lower compared to our expectation of 20.8%. The management has highlighted that the strong outlook on terms of revenue growth continues. They have got good large deal wins, but the margin is something that they have guided for at the lower end of the guidance band. That is, their guidance was 21 to 23%, and they have guided that it could be lower at the lower end of this band. However, they have upped or increased the revenue guidance. So I think the reaction to the results is not that strong positive. But if you look at the long-term picture, the strong revenue growth, the strong guidance, that is the key. And we have seen historically how these companies manage costs and bring in efficiencies to improve margins. That will take maybe 2-3 quarters, but that's a good time for investors to look into a space which is kind of can give you strong growth potential, especially the post-COVID era, where the world is moving towards digital, is spending a lot towards improving their technology. So I think IT will be a key beneficiary of this increasing spends towards the digital as well as the cloud shifting.
Okay, so between the bellwethers, the long-standing debate, where should you be really put your focus in? What is your best bet between, say, TCS, Infosys, Wipro, HCL Tech? Where are you really, positive on in the future, which could give you better returns than the others?
Yeah, so Sakshi, if you look at the preferred pick in the IT space, I think we like the preferred pick is Infosys, given the strong growth, industry-beating growth that they have been continuously reporting. And compared to that, the valuations are also comfortable. While TCS is also started now reporting healthy growth in terms of the overall revenue, I think the valuations do continue to trade at a premium. So that would be the second preferred bet. I think Wipro, they're disappointed in terms of numbers, and there are other challenges as well in terms of scaling up. So I think that's not the preferred pick. So the preferred order would be Infosys, TCS, followed by HCL Tech.
banking space, where again we've seen solid numbers come out. ICICI Bank has reported about a 50%, 55% jump in the June quarter consolidated net profit to over 7,300 crore rupees. That's helped by a sharp reduction in the provisions, the core interest income continuing to be strong. On a standalone basis, also it reported a net profit of about 6,900 odd crore rupees. So that's seen a jump on a year-on-year basis again. The stock has, definitely risen about 2% odd. It reacted on the positive side as the D Street cheered the steep decline in bad loans. ICICI Bank, would you still say, Siddharth, it's a good bet post these earnings, or has it become an overcrowded trade? Would you still go for the stock post a strong show?
Yeah, Sakshi. So I think stellar numbers from ICICI Bank. They keep on raising the benchmarks with exemplary performance every quarter. And if you look at the overall performance, it only adds on to the overall view in terms of ICICI Bank. Over the last couple of quarters, we have seen that due to the intense FII selling, the absolute performance was kind of somewhat limited. However, if you look at the execution and the performance, it only matter of time when ICICI valuation will start to expand to its deserving multiples. Numbers wise, net profit grew 50%. The net interest income was up 21%, which was in line with our expectation. The net interest margins, NIMs, further improved 4.14%, and there was healthy loan book growth of 21%, and it was across the healthy, or you can say the profitable businesses which kind of lent to the loan book growth, the retail, the business banking, the home loans, credit cards, personal loans. So these segments kind of supported the growth, which are kind of adding to the overall profitability. If you look at the asset quality, I think it is very healthy. Slippages were controlled. Gross NPAs and net NPAs further contracted. So gross NPAs at 3.4%, net NPA at 0.7%. Provision coverage ratio at 80% is among one of the healthiest within the banking space. So overall, I think we continue to see a robust operating performance from ICICI, driven by healthy core business performance, controlled provisions, and a healthy provision coverage ratio. So it's a good mix of high-yielding portfolio. Going forward, we expect the new growth cycle in the economy to help the ICICI, which is already positioned well with strong balance sheet and robust capitalization. So we expect the ROEs to improve over the next few years, and we believe that the valuation multiple should re-rate strongly from here. So ICICI is our top pick within the banking space. We have a target of 1,050 from a one-year perspective, but I think the kind of growth that they are delivering, one can definitely look for a 3 to 4 year kind of a compounding story in ICICI Bank.
And vis-a-vis HDFC Bank and Kotak Mahindra Bank that also came out with good earnings this time around. What are your thoughts here?
So I think Kotak, they reported a decent set of numbers. However, there was some miss in terms of margins, especially because of the lower other income and as well as treasury income. There was some provisions right back, which helped to report a decent numbers. But nonetheless, the core business performance was very strong. The only concern there is of valuation. It continues to trade at a higher valuation. So in terms of business-wise, we are very positive. But in terms of the view, we have a neutral rating on Kotak Mahindra because of the high valuation. So again, we would prefer ICICI. HDFC reported strong numbers. So things are again kind of coming back for HDFC. We have a positive view with a buy rating. But I feel that over the next 1.5 to 2 years, the bank's management focus would be more towards integration with the HDFC Limited, getting all the approvals, getting the things on ground to integrate. And I think that might kind of somewhere shift the focus from the core business towards the business integration, the merger related issues. And hence, the preferred company or bank in terms of the strong growth would remain ICICI, followed by an SBI and then maybe an HDFC Bank.
Okay, understood that. One last earning that we are going to discuss on this show is Ultratech Cement. Now, the shares dropped about 2% intraday after the company declared the earnings. The largest cement manufacturer in India reported a 6.8% decline in the net profit this time around, against a year back. And sequentially, the company's profit has declined 35%. So we have seen that the cement companies have had a bad quarter so far. Things have not really worked out. Of course, the monsoons have started again, so not very conducive time for them. But the company definitely beat some of the street estimates on the profit front. So what would your thoughts be on Ultratech Cement, and especially with the macro changes around Adani coming into picture, all of those things? How will this shape the cement space and Ultratech Cement there?
Sure, sure. I think Ultratech is cementing its leadership position very strongly. While we have now a new player and a very strong player in the name of Adani coming into the Indian cement space, that will only lead to further consolidation of the smaller capacities,
Yeah.
where Ultratech is by far, you can say, way ahead of the competition. The management has now guided that by the end of this decade, that is FY 29-30, they would reach 200 million tons of capacity, and that is really kind of setting the huge entry barrier for others to increase capacity, given their strength in terms of delivering these capabilities, getting this capex on stream, as well as the strong brand name and presence across India. So result-wise, it was a very strong numbers, much ahead of expectation, mainly on back of higher volumes and better cost management. Again, this sector is impacted because of higher costs in terms of raw material, logistics, power, fuel. I think that combined with the monsoon season leading to some compression in realization, could see some softness for one or two quarters, but the strong demand outlook continues, and delivery by Ultratech would bring focus on some of the other cement companies, especially from a results perspective this season.
Yeah, absolutely. Well, thank you so much, Siddharth, for being with us and breaking down and sharing all the fine print of these big earnings that we've just seen, and helping all our viewers really understand how to approach all of these stocks post the Q1 numbers too. Thank you so much for being with us.
Most welcome. Thank you.
If you like the video, do like, comment, share and subscribe.